History is often written by the victors, but in the world of high finance, winners are sometimes punished for winning too big. Imagine a man who placed the single most audacious bet in the history of Wall Street. He did not bet on a new drug, a revolutionary smartphone, or a social media trend. Instead, he bet the entire future of a publicly traded company on a digital asset that traditional bankers called a scam. For a long time, it looked like he had won. Today, Michael Saylor and his company, MicroStrategy, sit on a mountain of digital gold. We are talking about 649,870 Bitcoin. At current market valuations, that is a staggering $54 billion. It is a treasure chest larger than the gold reserves of many sovereign nations. MicroStrategy has transformed from a quiet enterprise software firm into a massive financial juggernaut. Its stock price has not just grown, it has gone parabolic, outperforming almost every other major asset class over the last 4 years. For the individual investor, Michael Saylor became a hero. He provided a bridge between the old world of the stock market and the new world of decentralized finance. But while the retail world cheers, a cold and calculated mechanism is moving against him in the shadows of the institutional system. Wall Street operates on a set of rigid rules designed to maintain stability and, more importantly, control. To the committee that manages the NASDAQ 100 index, Michael Saylor is no longer a visionary entrepreneur. He has become a systemic risk. By concentrating over 50% of his company assets into a single volatile digital currency, Saylor has broken the cardinal rule of modern portfolio theory, diversification. Because of this, the financial establishment has quietly activated a kill switch. The date is set. January 15th, 226. This is not just another day on the trading calendar. It is the deadline for the annual NASDAQ index rebalancing. For MicroStrategy, this date represents a potential financial execution. If the committee decides to delete the company from the index, it will trigger an automated, non-negotiable wave of selling that the market might not be able to survive. We are talking about billions of dollars in stock being dumped by computer algorithms that do not care about value, vision, or the future of money. This is the story of a $54 billion score and the institutional trap that is now closing around it. It is a tale of how the traditional banking system uses its own bureaucracy as a weapon to reclaim territory lost to the crypto revolution. In this video, we will dissect the mechanical precision of the index deletion process, the hidden debt structures that could lead to a death spiral, and the theory that this entire crisis was engineered by the very banks that claim to be protecting you. The stakes have never been higher. If Michael Saylor falls, he will not fall alone. He will take a significant portion of the global Bitcoin market with him. This is the endgame for the greatest trade of the century. To understand the gravity of the current situation, we must first look back at the radical transformation of MicroStrategy. For decades, this company was a steady, yet unremarkable, enterprise software firm based in Virginia. It provided business intelligence tools to corporations, generating consistent but modest profits. However, by the year 2020, the global economic landscape changed forever. The pandemic triggered an unprecedented expansion of the money supply, with the Federal Reserve printing trillions of dollars to stabilize the economy. Michael Saylor, the founder and then chief executive officer, saw a looming crisis. He realized that the cash sitting on his company balance sheet was a melting ice cube, losing purchasing power every single day due to monetary inflation. Instead of following the traditional corporate playbook of buying back shares or issuing dividends, Saylor chose a path that many at the time called insane. On August 11th, 2020, MicroStrategy announced it had purchased $250 million worth of Bitcoin. It was the first time a major publicly traded company in the United States had adopted a digital asset as its primary reserve currency. Saylor was not just buying an investment, he was adopting what he called the Bitcoin standard. He argued that Bitcoin was the first engineered monetary system in human history, a form of digital energy that could preserve wealth across time and space without the interference of central banks. The strategy did not stop with that initial purchase. Over the next 5 years, Saylor became the most aggressive buyer of Bitcoin in the world. He used every financial tool available to him. He used the cash flow from the software business. He issued new shares of stock to raise capital. Most controversially, he turned to the debt markets. MicroStrategy began issuing hundreds of millions and eventually billions of dollars in senior secured notes and convertible bonds. The goal was simple: borrow depreciating fiat currency to acquire an appreciating, scarce digital asset. By the start of 2026, the results were undeniable. MicroStrategy had accumulated over 649,000 Bitcoin. The company had essentially turned into a massive, leveraged Bitcoin exchange-traded fund with a software business attached to its side. For investors who were restricted from buying Bitcoin directly due to regulatory or institutional hurdles, MicroStrategy stock, known by its ticker MSTR, became the ultimate loophole. It offered high beta exposure to the cryptocurrency market with the liquidity and regulatory oversight of a NASDAQ-listed company. As Bitcoin surged toward new all-time highs, the valuation of MicroStrategy exploded. The company was no longer valued on its software earnings, but on the massive premium of its digital holdings. Saylor had successfully front-run the entire institutional world. He had forced the hand of Wall Street, compelling pension funds and massive asset managers to indirectly hold Bitcoin through his shares. However, this aggressive accumulation created a massive concentration of risk. By winning the Bitcoin bet so decisively, Saylor inadvertently turned his company into a giant target for the gatekeepers of the traditional financial system. He had built a fortress of digital gold, but the foundation was built on the very system he was trying to escape. In the world of the NASDAQ 100, size is not the only thing that matters. While MicroStrategy has grown its market capitalization to rival some of the most established industrial giants, it is operating within a framework of rules that were never designed for a Bitcoin treasury company. The NASDAQ 100 is often called the index of the future, representing the top 100 largest non-financial companies listed on the exchange. But as Michael Saylor pushed his company further into the digital frontier, he crossed an invisible line that the index committee cannot ignore. The first conflict lies in the very definition of what a company is. The NASDAQ 100 explicitly excludes financial companies. This category traditionally includes commercial and investment banks, insurance companies, and asset managers. For decades, MicroStrategy was safe because it was classified as a technology company, specifically in the business intelligence software sector. However, when a software company begins to derive the vast majority of its value not from its code or its customers, but from a $54 billion hoard of cryptocurrency, the classification begins to blur. Financial analysts and index providers like MSCI have already begun to raise questions. They argue that MicroStrategy has essentially transformed into an unregistered investment fund. If the committee reclassifies the company as a financial entity, its removal from the index becomes mandatory and automatic, regardless of its size. According to the index methodology, if a single company becomes too dependent on a single asset, or if its asset concentration exceeds 50% of its total holdings, it triggers a red flag for the rebalancing committee. In the eyes of the establishment, Michael Saylor has turned MicroStrategy into a mono-risk entity. For a traditional investor, the NASDAQ 100 represents the growth of American technology. Apple, Microsoft, Nvidia, and Amazon. These are companies with thousands of products, global supply chains, and diversified revenue streams. MicroStrategy, by contrast, has become a proxy for a single, volatile, digital commodity. This concentration creates a paradox. The more Bitcoin goes up in price, the more MicroStrategy violates the diversification rules of the index. By winning his bet, Saylor is systematically disqualifying himself from the club. The NASDAQ committee operates on the principle of stability. They do not want the most popular tech index in the world to be held hostage by the price swings of the cryptocurrency market. If Bitcoin drops 30% in a weekend, they do not want the entire NASDAQ 100 to be dragged down because one software company chose to become a digital vault. The final factor is the pressure from the regulatory environment. The Securities and Exchange Commission and other financial watchdogs have always been wary of companies that act like investment funds without being regulated as such. By keeping MicroStrategy in the index, the NASDAQ is essentially endorsing a high-leverage Bitcoin play to every pension fund and retirement account that tracks the QQQ. For the gatekeepers of the old system, this is an unacceptable liability. They are not just looking at the numbers. They are looking at the rules of the game. And those rules state that once you stop being a software company and start being a Bitcoin bank, you are no longer welcome in the index of technology leaders. The trap is not just financial, it is bureaucratic. And the deadline of January 15th is when these invisible rules will finally manifest into a hard reality. In the financial world, volatility is often a random storm, but sometimes a disaster is scheduled down to the exact hour. For Michael Saylor and every investor holding MicroStrategy stock, that date is January 15th, 226. This is not merely a bureaucratic milestone, it is the moment when the mechanical gears of the global financial system are set to rotate, and they may rotate right over the top of the world's largest corporate Bitcoin bet. To understand why this specific date is a trigger for chaos, you have to understand the ritual of index reconstitution. The NASDAQ 100 is not a static list. Every year, in December and January, the committee reviews the performance, market capitalization, and compliance of its member companies. They decide who stays in the club and who gets evicted. If MicroStrategy is flagged for deletion due to its asset concentration or its reclassification as a financial entity, the announcement will send a shockwave through the markets long before the actual trading begins. The chaos begins with the passive investment giants. Funds like the Invesco QQQ Trust, which manages hundreds of billions of dollars, are legally and structurally bound to follow the index. They do not have a choice. They do not have a portfolio manager who can say, "I believe in Michael Saylor, let's keep holding." The moment the index changes, the computers take over. On the effective date of the rebalancing, these massive funds must execute sell orders for every single share of MicroStrategy they own. We are talking about a forced liquidation of millions of shares, potentially representing billions of dollars in value, all hitting the market in a highly compressed time frame. This is what market analysts call a liquidity event, but in this case, it looks more like a liquidity vacuum. Under normal conditions, a stock has a balance of buyers and sellers, but during a forced index deletion, the buyers suddenly vanish. Think about it. If every major index fund is selling at the same time, who is on the other side of the trade? Institutional buyers who are not forced to buy will simply step back and wait for the price to crater. They know the selling is mandatory and price insensitive. They will wait for the blood in the streets before they even consider stepping in. For MicroStrategy, the timing of this countdown is particularly dangerous because of its leverage. Michael Saylor has used the premium on his stock to issue more debt, to buy more Bitcoin. This works beautifully when the stock is included in major indices and has a constant stream of passive buyers. But if that stream turns into a flood of selling, the stock price could fall far below its net asset value. This creates a terrifying reality for January 15th. It is a day when the sheer math of the traditional financial system could overwhelm the conviction of the digital asset revolution. The countdown is not just a clock ticking, it is the sound of a trap being primed to snap shut. To understand why the January 15th deadline is so dangerous, we have to look into the engine room of MicroStrategy. Michael Saylor did not just buy Bitcoin with the company profits. He used a high-stakes strategy known as financial engineering. The primary tool in his arsenal is the convertible senior note. These are complex financial instruments that are part debt and part equity. Essentially, MicroStrategy borrows billions of dollars from institutional investors at very low interest rates, sometimes as low as 0%. In exchange, these investors get the right to convert their debt into MicroStrategy stock at a future date for a predetermined price. On the surface, this looks like a genius move. When the price of Bitcoin goes up, the price of the stock follows, and the debt holders are happy to convert their notes into valuable shares. This allows the company to effectively wipe out its debt without ever paying back the cash. But this entire structure relies on one critical pillar, a high stock price. The convertible notes are designed to be attractive when the stock is trading at a premium. As long as the market values MicroStrategy at more than the Bitcoin it holds, the machine keeps spinning. However, the upcoming NASDAQ deletion threatens to shatter this fulcrum. When a stock is removed from a major index, the resulting forced selling by passive funds creates a massive downward pressure on the share price. If the stock price falls below the conversion price of these billions of dollars in notes, the debt no longer converts into equity. It remains as debt. And unlike equity, debt must be repaid in cash, with interest. According to financial filings from late 2024 and early 2025, MicroStrategy has issued multiple rounds of these notes, with maturity dates stretching toward the end of the decade. While many of these notes do not mature immediately, they contain protective covenants. If the company's financial condition deteriorates significantly, or if its market capitalization falls below certain thresholds, some lenders may have the right to demand early repayment or additional collateral. This is where the engineering could transform into suicide. If MicroStrategy is forced to find billions of dollars in cash to satisfy nervous lenders or to cover interest payments in a falling market, it has very few options. It cannot rely on its software business, which generates only a fraction of the cash needed. It cannot easily issue more stock if the price is already in a freefall. That leaves only one source of liquidity, the $54 billion Bitcoin hoard. But selling the Bitcoin to pay the debt is the one thing Michael Saylor promised he would never do. The moment the first Satoshi is sold to cover a debt obligation, the market's trust in the Bitcoin standard will evaporate, turning a calculated strategy into a desperate scramble for survival. The danger of Michael Saylor's strategy is not just about debt or index rules. It is about the physical limitations of the market itself. In the world of finance, there is a massive difference between having a net worth of $50 billion and having $50 billion in cash. This difference is called liquidity. As of early 2026, MicroStrategy holds over 649,000 Bitcoin. On paper, this makes the company one of the wealthiest entities on Earth. But if the NASDAQ deletion triggers a forced sale, Michael Saylor will face a terrifying reality: the liquidity black hole. To understand this, we must look at the actual depth of the Bitcoin market. While the total market capitalization of Bitcoin might be in the trillions, the amount of Bitcoin available to be bought or sold at any given price, what traders call the order book depth, is much smaller. Recent market data from late 2025 shows that even a sell order of $500 million can move the price of Bitcoin by several percentage points on major exchanges like Coinbase or Binance. Now, imagine an order 100 times larger. If Michael Saylor is forced to sell just 10% of his holdings to cover debt obligations or interest payments, he would be dumping over $5 billion worth of Bitcoin into the market. In a high-stress environment where the Nasdaq is already deleting MicroStrategy, there would be no willing buyers to absorb that much supply. This creates a phenomenon known as slippage. Slippage occurs when there are not enough buy orders at the current price, forcing the seller to accept lower and lower prices to complete the trade. For a position as large as MicroStrategy's, slippage wouldn't just be a few pennies. It could be 20, 30, or even 50%. The moment the market senses that Saylor is a forced seller, the sharks will circle. High-frequency trading algorithms and institutional short sellers will front-run his orders, driving the price down even faster. They know he has no choice but to sell, so they will pull their buy orders and wait for the price to collapse. This is why it is called a black hole. The more you try to exit, the more the market pulls the price away from you. The impact would ripple far beyond MicroStrategy. A flash crash in Bitcoin, triggered by the world's largest corporate holder, would liquidate billions of dollars in leveraged positions across the entire crypto ecosystem. Retail investors who bought Bitcoin at $90,000 or $100,000 would see their portfolios evaporate in hours. This is the systemic risk that the Nasdaq committee fears, and ironically, it is the very risk that their deletion of the company might actually create. We are looking at a scenario where the exit door is simply too small for the giant trying to run through it. In the world of high finance, there are no accidents, only carefully executed plans. As we approach the January 15th deadline, a dark theory has begun to circulate among seasoned market observers. They call it the bank heist theory. The premise is simple yet chilling. The traditional banking establishment is not trying to protect the market from Michael Saylor. They are trying to strip him of his treasure. For years, the titans of Wall Street, the same banks that now control the massive Bitcoin exchange-traded funds, watched from the sidelines as Saylor front-ran them, accumulating a supply of Bitcoin that rivals the reserves of central banks. The theory suggests that the institutional system set a trap by allowing MicroStrategy to grow unchecked using high-leverage debt. By providing the capital for Saylor's convertible notes, the banks essentially handed him the rope to hang himself. They knew that as long as MicroStrategy was the primary way for institutions to get Bitcoin exposure, the stock would trade at a massive premium. But they also knew they held the ultimate weapon, the index rules. By moving to reclassify MicroStrategy as a financial entity or citing concentration risks, they can trigger the very liquidation event we have discussed. Think about the timing. In late 2024 and throughout 2025, companies like BlackRock and Fidelity successfully launched their own spot, Bitcoin ETFs. These products offer the same Bitcoin exposure as MicroStrategy, but with lower fees and without the corporate debt risk. For the first time, Wall Street has a competing product. They no longer need Michael Saylor to be the bridge to the crypto world. In fact, he is now their biggest competitor for institutional dollars. If MicroStrategy is deleted from the Nasdaq 100, those billions of dollars in passive capital will not just vanish, they will likely be reallocated into the very ETFs managed by the same banks pushing for the deletion. But the heist goes deeper than just redirecting fees. If the forced liquidation of MicroStrategy stock causes a flash crash in Bitcoin, who will be standing there with billions in cash to buy the dip? It will be the same traditional financial institutions that have spent the last year building their digital asset infrastructure. They can acquire in a single week of forced selling what took Michael Saylor 6 years of aggressive accumulation to build. They don't want to destroy Bitcoin. They want to own it at a massive discount. By using the bureaucratic machinery of the Nasdaq and MSCI indices, they can engineer a wealth transfer of historic proportions, all while appearing to follow the rules of the market. Michael Saylor thought he was outsmarting the banks by using their fiat system to buy digital gold. He may soon find out that the banks were simply letting him hold the gold until they were ready to take it. To the casual observer, Michael Saylor's current predicament might seem like a unique modern phenomenon, but for those who study the long arc of economic history, the patterns are hauntingly familiar. The financial establishment has a long memory, and they have used the same playbook for over a century to dismantle concentrated market positions that threaten their control. To understand the trap set for MicroStrategy, we must look at two pivotal moments in history: the Hunt brothers' attempt to corner silver and the catastrophic collapse of long-term capital management. In the late 1970s, Nelson Bunker Hunt and William Herbert Hunt decided to protect their wealth from inflation by buying silver. Much like Saylor's belief in Bitcoin, the Hunts believed that paper currency was a dying illusion. By early 1980, they had accumulated an estimated 100 million to 160 million ounces of silver, controlling nearly one-third of the world's privately held supply. The price of silver skyrocketed from $6 to nearly $50 an ounce. They appeared to have won the trade of the century. But then, the system struck back. Just like the Nasdaq committee today, the regulators and exchanges in 1980 changed the rules of the game mid-match. On January 7, 1980, the Comex exchange implemented Silver Rule 7, which placed massive restrictions on purchasing commodities on margin. Shortly after, they declared the market liquidation only, meaning traders could sell silver but they could not buy it. Without new buyers, the price collapsed by over 50% in a single day, an event known as Silver Thursday. The Hunts were decimated not by the market, but by a sudden change in bureaucracy. 2 decades later, in 1998, another giant fell. Long-Term Capital Management, or LTCM, was a hedge fund run by Nobel Prize winners and the brightest minds on Wall Street. They used extreme leverage at one point, reaching a ratio of 25-1 to bet on the convergence of global bond prices. They were so large that they believed they were the market. But when Russia defaulted on its debt, the liquidity dried up instantly. LTCM held over $1 trillion in derivative positions on a capital base of only $4 billion. The lesson from LTCM is about the death spiral of forced liquidation. When the fund could no longer meet its margin calls, it was forced to sell its most liquid assets to stay afloat. This selling drove down prices, which triggered more margin calls, requiring even more selling. The Federal Reserve eventually had to step in to broker a $3.6 billion bailout by 14 private banks, not to save the fund, but to prevent the entire global financial system from being dragged into the black hole. Michael Saylor is now walking the same tightrope. Like the Hunts, he has a concentrated position that regulators are eyeing with suspicion. Like LTCM, he has built an empire on leverage and the assumption of perpetual liquidity. History shows us that when a single player becomes too large or too bold, the house changes the rules to ensure the house always wins. January 15th is not just a date on a calendar, it is the modern equivalent of Silver Rule 7. As the January 15th deadline approaches, the financial world is asking a single question. Is Michael Saylor a helpless victim of the system, or does he have one last move on the chessboard? To believe that Saylor is unprepared is to ignore the last 5 years of meticulous financial planning. He is fully aware that the traditional gatekeepers are closing in, and he has already begun to deploy a series of sophisticated countermoves designed to stabilize the ship before the storm hits. The first line of defense is a fundamental shift in the company's narrative. In late 2025, Saylor began rebranding MicroStrategy, now officially known simply as Strategy, not as a software firm or a Bitcoin holding company, but as a Bitcoin-backed structured finance company or a capital markets platform. By repositioning the firm as an operating business that uses Bitcoin as productive capital to issue digital credit, Saylor is attempting to bypass the MSCI and Nasdaq rules that define his company as a mere investment fund. He is arguing that Strategy is an active financial innovator, similar to a bank but built on a superior reserve asset. Beyond the narrative, the company is building a physical firewall of cash. In December 2025, Strategy announced the creation of a $1.4 billion cash reserve. This liquidity cushion was funded by aggressive at-the-market equity sales and the issuance of new preferred stock. The purpose of this fund is specific and defensive, to cover at least 21 months of interest and dividend payments without being forced to sell a single Bitcoin. This reserve acts as a circuit breaker against the death spiral, ensuring that even if the stock price collapses and credit markets tighten, the company can meet its immediate obligations. Furthermore, the CEO of Strategy, Fong Lei, has signaled a strategic flexibility that was previously unthinkable. While Saylor remains the face of the unwavering Bitcoin hodl strategy, the company leadership has publicly stated they would consider selling Bitcoin under extreme conditions if the market value of the company falls below the value of its Bitcoin holdings, a metric known as the MNAV. This is a message to the short sellers. The company will act rationally to protect shareholder value. Perhaps most importantly, Strategy is in talks with major traditional banks like BNY, Mellon, and Wells Fargo to enter the Bitcoin management space. By inviting the establishment to profit alongside him, Saylor may be trying to turn his enemies into partners. If the major banks have a vested interest in the success of Strategy's Bitcoin-backed credit products, the pressure to delete the company from indices may mysteriously vanish. Saylor is betting that in the end, Wall Street's greed for new fees will outweigh its desire to destroy a competitor. The question remains, Is a $1.4 billion shield enough to stop an $8 billion wave of forced selling? As the sun sets on the first weeks of 2026, the battle for the soul of MicroStrategy has reached a fever pitch. We are witnessing a collision between two irreconcilable worlds. On one side, we have the decentralized, immutable digital energy of Bitcoin, championed by a man who has bet his entire legacy on its success. On the other side, we have the rigid, bureaucratic, and highly efficient machinery of the traditional global financial system. The deadline of January 15th is not just a date for a committee meeting, it is a referendum on whether the old world can successfully exile the new. If Michael Saylor survives this index purge, it will be the ultimate validation of the Bitcoin standard. It will prove that a company can indeed move beyond the constraints of traditional diversification and build its own sovereign treasury. It would signal to every other CEO and nation-state on the planet that the rules of Wall Street are not absolute and that there is a way to opt out of the melting fiat ice cube. MicroStrategy would no longer be seen as a risky bet, but as the blueprint for the corporate finance of the 21st century. However, if the forced liquidation occurs, the lesson for investors is equally profound. It will serve as a stark reminder that liquidity is a weapon. In the current system, being right is not enough. You must also be able to survive the mechanical reactions of the market gatekeepers. The bank heist theory may or may not be true in its most conspiratorial form, but the reality is the same. The institutional system is designed to absorb and control anything that grows too large outside its walls. For the individual investor, this means that the road to financial sovereignty is paved with systemic traps that require more than just conviction. They require an understanding of the plumbing of global finance. We are living through a period of historic wealth transformation. Whether you are a Bitcoin believer, a skeptic, or simply a concerned observer of the markets, the saga of Michael Saylor and the Nasdaq 100 offers a vital masterclass. It shows us that capital is no longer just a medium of exchange, it has become a form of sovereignty. As we move further into 2026, the line between technology and finance will continue to blur, and the battles will only get larger. The question for you is simple. Are you following the crowd into the passive index traps, or are you building your own treasury? January 15th may be the end of an era for MicroStrategy as a member of the old club, but it might also be the beginning of a new era where capital answers to no committee. The countdown is almost over. The world is watching, and the future of money hangs in the balance.